always good for me to know what my counterparts are up to out there. But tactical asset allocation is a topic that's on just about one per week, one e-zine out of every week's 5 or 6 magazines that I get online, and we're going to help you determine what the next hot sector is, and it can't be done. So beware of tactical asset allocation. Charlie Ellis, I think I've got his book around here. He writes Winning the Loser's Game, and he writes a book on investment policy. He says the evidence with investment managers and their success with market timing is impressive and overwhelmingly negative. There is not an academic who has done the research in the last 50 years that will tell you market timing works, because there is no evidence of it whatsoever. And yet we think that my broker or my investment manager knows when to get in and when to get out. And most of the time how this plays out is not in them calling you proactively. Think about it. Have you ever been proactively called and said, I think the market's going down and I think you should get out? No. The market has come down a little, you're feeling nervous, you call them and they start talking to you about it. Well, if you feel like... So if you think about how the conversation gets started, it starts with your emotion. It compounds with the investment manager's emotion, which has a lot to do with whether or not you're going to pull your money. And the whole conversation goes down the road of, how do I keep your money? And if that means I have to move you out of the market to make you feel more comfortable, until you feel more comfortable, I'll move you back in. Investment managers are helping clients do amazingly bad things simply to keep the money under management, and nobody's tracking it. And it's a bad system. And it can be changed. The costs of investing. The last one, fees incurred by investors to buy, sell, or own stocks or mutual funds. You expect there to be fees when you own investments, and there will be. But the myth is that what you don't see can't hurt you. And there are a lot of fees that you don't see. We'll go through a couple of them. The bid and the ask spread. Has anyone ever heard of that on stocks? The buy price is always different than the sell price in mutual funds. And here's how it works. The sell price, if I wanted to buy some small company today, $49.50, and I say, you know what, I've got 100 shares of this company, I'll call a big one like IBM or something, and I want to sell it. So I call my broker and I say, what can I get for it? $49.50. Great. Let me think about it for 5 minutes. I go back in my office and I think about it. I read an article or I get an email that says IBM's coming out with a great new product. I think, you know what, I think I want to buy. I don't want to sell. I want to buy. So I say I want to buy. I call them up and say, nope, I have 100 shares. I want to double down. I want to go 200 shares of IBM, so I'm going to buy 100. $49.50, that's $4,950. He said, nope, that'll be $50 a share to buy it. What gives? Well, there's a price to buy and sell stocks. And the price goes to the market maker, and it's called the bid and the ask spread. And you would expect, because I can't buy a stock from Stacy, it has to go through a market. And that has a lot to do with property rights and private ownership, and this is all very good. We want this. And there are prices to buy and sell, and we get something beneficial for it, but it does cost money to buy and sell. Inside the average mutual fund, anyone venture a guess as to how often the average mutual fund turns over? In other words, how many times the mutual fund manager is buying and selling inside that mutual fund? Any guesses as a percentage? 50%? Over a year? Pardon? Over a year? Over a 1 year period, an annual turnover rate. The average is up over into the 115 plus or minus range, 115% turnover. So if there are 200 stocks owned inside of a mutual fund, there are over 200 trades during the year. Now, if IBM is a good investment, why do we have to sell it and buy it 6 times from January until December? Well, the reason is the manager believes they're bringing the return, right? They believe that their buying and selling companies are what creates the return. They believe they're buying low and selling high within your mutual fund. The problem is there's no evidence that says that there is a positive correlation. We've seen their track record. Some win, but no one wins long enough. And the ones that win, generally the money comes in after they win, and then they lose. In fact, I could say always. There's no correlation between their buying and selling. What is there a correlation between with respect to their buying and selling? Income to the mutual fund company. So is it a conflict of interest, at least, that buying and selling at 115% creates income for them, no documented return for you, and yet it happens on an average of 100% more per year? This is going to be in the news. You'll watch it when Lawmakers have more time, it's already on their docket, they're gonna be dealing with this, and turnover rates hopefully will start to come down, because there is no documented evidence of turnover rates accruing positive returns for investors over long periods of time. Well, there's only anecdotal evidence that some mutual fund managers win for short periods. But there's no way you're gonna get into them ahead of time because you don't know who they are unless you got lucky. So you got to get lucky twice. The mutual fund manager has to get lucky in buying and selling at the right clip, and you've got to get lucky in getting them ahead of that period of time. And the fact that some people win in Vegas makes me feel like, hey, maybe I should go to Vegas.